Now, this is investment risk. So it's different to a person's risk or a person's willingness to take risk, okay? So that's the one risk category. Then we speak to people who are actually investing their money. A person's risk has two elements to it. They have the risk they're willing to take, i.e., you can ask someone, how do you feel about the market? Well, I'm pretty confident about it. I know what I'm doing. I've read books or even I've been a professional investor. Okay, how do you feel about this pot of money, whether it's a pension or an ISA or another investment vehicle? How do you feel about that pot of money losing 10, 20, 30% in any given year? And this is different, right? Because for a pension, you may have 20, 30, 40 years till you retire. So that's okay. So, in 1 year, I can take a 30% hit because we've got time to recover. But this ISA, I'm actually saving up for school fees, and I'm going to need it in 3 to 5 years. So no, I can't take that kind of hit because we don't have the time scale to make it up. So the time scale of the investment is very important to the willingness of the person to take a risk, right? And this is the risk of markets going up or down. And remember, if you've got everyone has this, okay? No one has the expectation of getting more returns, or you might think that that's what they would have, but everyone has the aversion to loss. So rather than expecting greater returns, people expect less loss. That's the kind of psychological bias for people. So you've got to make sure that you limit that for them. And we can do that through diversification. We kind of can stick it in a corridor. Yes, it goes out now and again, but for most of the time, the math works. So then you talk to the person and say, okay, you're willing to kind of take this level of volatility, which we know. So if it goes, I know if someone can only tolerate a 10% downfall, then they're not going to participate in all the upside of the market, because we have to use asset classes to protect that, which will then dampen the upside, right? Makes sense. Yeah. So you have this corridor. Then I look at the person's capacity for loss. Now, this is the second part of the risk equation. So the first part of the risk equation is how willing are they to take the risk, and what is the time scale for that risk, right? And then the capacity for loss has another look. It says, okay, I know what you're willing or you want to do, and I know what you want to achieve, and I know the time scale you want it in, but can you actually do it? I.e., what are your assets in the background? What is your background? How stable is your job? How stable is your home life? And all of that kind of useful information. Because let's say you say, look, I'm high risk because I'm 25 years old. I'm investing into an ISA, and I've also got my pension. But you don't have a stable job. You don't have a stable income, and you may rely on this money sooner than you expect. We may knock you down a couple of risk levels. Just say, you know what? Let's just be a little cautious, because your capacity for loss is a little bit low at the moment, and that can always change, but let's be a little cautious. Or can go the other way. Someone can say, look, I don't like risk, I don't want to take risk in the market, but their capacity for loss is actually quite high. So the money they're investing, it actually is not going to affect their lifestyle in any meaningful way, i.e. the way they live day to day, if they take a loss on this money. So we say, look, in order to achieve the goals you need, maybe we should get this risk up 1 or 2 notches. And people generally accept those discussions. We don't do a risk. And please, if you go to a financial advisor and he takes out a 1 to 10 bloody risk graph, just say, that's useless to me. You don't want that. You don't want to be scaled on a 1 low risk, 10 extreme risk, because that stops the conversation around it. It stops the meaningful conversation of how much risk you're willing to take. Do you know what the risk is? What is your time scale? And let's have a look at all your other assets and make sure that you can take the risk you want to, or you're taking enough risk you need to. And that's one point. So I don't use 1 to 10. I don't, we can say, okay, you're a medium risk at the end of it, or a high risk or a low, but yeah, so that's it. And then you can build a portfolio or stick them into a model portfolio, which is generally good if you've got a good investment management proposition at the back of you.